Hello and welcome back to Channel 11 News. I'm your host today, Ken Shinoda, March 25th, 2021. I've got Jeff Sherman, Deputy CIO, with us today. Jeff, thanks for coming in.
Yeah, good to see you.
We're here 1 year later after the start of COVID and the crazy ride in markets we had. So we thought we'd talk about markets, talk about what happened last year, the performance of assets thus far this year, and kind of our outlook for certain key parts of the markets that our viewers are interested in, probably mainly bonds and stocks today.
All right.
So Jeff, how you been? Good to see you.
Not bad. It's a year and 2 weeks since we packed up from the office. In fact, it was actually 2 weeks ago, 1 year ago. It was the day that we really started to shut down. So it's kind of surreal seeing how the world's changed from there. But definitely, if you'd have fell asleep, I like to call it the Rip Van Winkle approach. If you'd have fell asleep and woke up a year later, who would have thought we had a pandemic, one of the worst economies ever, on the back of what was the greatest economy ever?
Yeah.
And I know we're going to talk about markets too, but definitely a disconnect between economic fundamentals and the forward-looking action of markets.
Yeah, and we talked about that a lot kind of in the middle of last year when stocks were going higher and higher and higher almost every day, and how there was that big disconnect.
Yeah.
And on that note, looking at the last 12 months, we've got a bunch of charts for our charts and graphs for our viewers today, but we thought this was pretty remarkable. The best 12 months ever, at least since 1936.
Yeah.
Right?
Yeah. No, I was doing that when we had our investment team meeting earlier this week, and when we were doing it, I was remarking on that we're going to get into the ridiculous time, right?
That's
where we
right.
look at these comparisons. So there's the ridiculous time of when everything got depressed, and then we call it base effects in economics, but with markets, we're picking off the lows at this point. And I was noticing one of our equity strategies was up like 95% on a 12-month basis. And it's like, that's great. But then when you look at the 13-month number, well, you're up about 20%. So in order to really achieve those gains, you had to ride the drawdown, or you had to buy the proverbial dip, right? Which I don't know how many people are actually willing and able to do at that point in time. But we do have some strange comparisons at this point in time. But it sure doesn't feel like we're up, 75+% in the S&P 500, right?
That's right. I mean, it's funny how in financial markets we like to look at these 1, 3, 5-year averages, and it's one month rolls off, and all of a sudden things start looking.
Yeah, it was horrific.
better.
It was horrific. On the I had a client review with someone, and they asked me, "Well, did you look at the 11-month number?" And I'm like, okay, well, that's great, but did you look at the 12-month number? Like in a bond portfolio, the 11-month number is like up like 27, 28%. But then when you look at the actual 12-month number, it's up about 6, right? So it just shows what an impact that illiquidity had within the marketplace.
Absolutely. Well, here's a snapshot of 2020, kind of that same story, pretty crazy returns in some parts of the equity market, with a NASDAQ up 45. I think it was up over 100 from the lows.
Right.
Great year for fixed income outside of some of the COVID hit areas. And commodities lagged during the beginning of the year, and then they caught a bid.
You saw the commodity market really perk up in the second half of the year, and it started really around the summertime. And we had that really anomalous event with oil prices going very negative. There was a short squeeze on out there that took place. I think a lot of our viewers are now more familiar with short squeezes with GameStop and the likes. Some of those things that had happened, but. What you see in the commodity market was very disparate too, because early on you saw the precious metals do quite well, except in that bout of illiquidity, everything went down. But you saw people worried about the reflation, the fact that you're going to have low growth rates, that gold, silver did very well. And then they really passed the baton on. And we saw this still, a lot of it came from China. If you recall, China really suffered COVID not in 2020. Remember, we're still doing COVID-19 here in 2021.
Yeah.
But if you think about it, they really started to improve really when we really got hit. So you saw the restocking take place. You saw that demand function come.
That's when the big demand came in for a lot of the copper and the industrial metals.
Correct, and
right?
Copper, nickel, zinc, a lot of the industrial metals came through there. And then you've also seen an uptick in food prices, agriculture and the like. So it's been this really, it's been one of these rare periods in commodities where they all did pretty well. Usually the benefit of commodities is diversification within the commodities, right? Because ag does does well in different environments from oil and the metals and the like. But what we've seen is a continued strength there. You've seen this now because where it was a supply, there's this restocking, the supply got diminished. Now you're seeing really supply shortages as demand picks up. And a lot of this is the reflation idea. So as you've seen in 2021, commodities have still done quite well. And I know we'll talk about it too when it comes to the inflation outlook there too. But I still remain personally pretty bullish on the commodity sector. For one, some of the supply, there's going to be supply constraints. Those supply constraints will stay for a while because it takes CapEx in these sectors. And I think a lot of people forget that. Like, you can't just crank up a mine. You can't go, oh, we need more copper supply. Let's just go start digging today and it's going to be great. You've got to set up the mine. You've got to get the pass to the smelting plant. You got to get it online. It takes a few years and it's highly capital intensive. So I think we're going to have a supply shock in the commodity market for a while now, just because that we're going to be constrained there, plus the pickup and the resumption of demand. So
it's interesting. Australia, which has been one of the most resilient economies, having like no recessions for this,
it's like 27 years, right?
Crazy period of time. Finally seemed like they were going to hit a bump with COVID, but with the jump in commodity prices, looks like they got bailed out again by the demand that's there.
And you've seen that from the Australian currency as well, right? And now you actually have where bond yields, the sovereign yields in Australia yield less than the U.S. And that was something that really kicked in last year too. So you do see a supportive economy there. And again, it's that connection to China as well. It's very helpful for the Australian economy.
Yeah, and lastly, in the currency space, dollar weakness with rates going to zero with QE infinity, but we're seeing a reversal of that, of course, this year with the rise in rates. So 2021, this is through 3/23, which actually it's the 1-year anniversary of the lows in equities.
That's right. That was when Jay Powell came in with his Pow policy,
right? That's right, Jay Powell Burr.
Yeah, and he turned on the money printer. And if you recall, that morning of the 23rd, there was the announcement where they were going to buy the kitchen sink, right? That they were going to support ad infinitum, whatever it took. They pulled out their Super Mario Draghi comments, and they delivered. What's amazing about that delivery, though, when you look at the facilities they set up, they were hardly used.
Yeah.
Most of them weren't touched. Even like the things like TALF, which I know investors were clamoring for. We opted not to do it because we thought that the ARB was going away. It turns out that was exactly spot on. But if you notice, they probably use like 5% of what they set aside for these facilities of just the capital, not including the leverage on it. So I think it was
market. They wanted to give the market confidence.
That's right. But this was exactly where they didn't have to do a policy. It was just speaking. And this shows you the power that we've entrusted in central bankers for markets, is that their words can drive the market more than actions. And they didn't have to deliver on the actions. And so most of those policies have been shut down now. But the facilities I said policies, I meant facilities. But those facilities can always be opened back up. And I think a lot of investors think that that's the case. So it's the Fed put on the Fed put. And we're just providing more support to the market.
Yep. And so equities are clearly in the green, but we'll get into it later. It's really a story of a mixed bag of some assets pulling back, like the high-flying tech and other assets doing well.
It's a reversal, right? I mean, this is what happens in markets where last year no one could really look through. It was that we're going to work remote. Everybody's going to use Zoom and Microsoft Teams, all this technology. And growth was scarce, right? So things that could grow traded at a significant premium. But remember, there's always a price of something, right? So even though it may seem like you want to own growth, well, as we've seen the vaccinations come in, the talks of the economy reopening, it's been this reflation idea. And so in a reflationary environment, we went back and I had the team pull together on the macro side some analysis on value versus growth and coming out of recessions. And this is the traditional path. When you're coming out of the recession, you want to own value over growth because the reflation trade kicks in and growth is no longer as scarce and the value actually does better. So it's one of those things where people look at the word growth and think, I want to own growth in a growth market. Actually, you want to own the thing that's more depressed, and that is the value stock today.
Yeah, they can catch up.
Yep.
Fixed income, of course, is the duration trade working in reverse. Last year, rates fell dramatically. This year, we're reverting back to what I like to think about as just a more normalized nominal yield environment.
Right, and if we're talking about growth, we're talking about perhaps some mix of inflation there. Yield should be somewhat normalized. And some people scratch their head and say, well, the Fed's pursuing a zero-rate interest rate policy. Well, that's the overnight lending rate. They don't target the back end of the curve. I don't think yield curve control's on the horizon. I just don't see it. Maybe if yields go up another 100, 150 basis points, maybe they start to think about it. But my core thesis there is that there's really no reason for the Fed to support it. Why is that? If you focus on the 10-year part of the curve, what is that? That's not really the economy. We always think about the economy as the 5-year part of the curve. Well, the 10-year, what does it do? It's got two major functions. One is the corporate bond market, right? So look back at last year plus year to date, we've had about $2.2, $2.3 trillion of corporate bonds. It's gross. So some of it's been refied, short up capital accounts and balance sheets. But so corporate America doesn't really need the support is my point there. Mm-hmm. Spreads are back to normal levels. Your yields are low all in. But the other thing, and I know you focus on this a lot in the housing market, is that if you think about the traditional 30-year fixed rate mortgage, it's keyed off the 10-year. So a lot of the strength we've seen in housing and the likes has been because of lower yields too. But do we really need to support the housing market as much as we have? And I'd argue no, with some of the price, the cure for high prices is high prices, we like to say. And so I think that, there's really no reason for the Fed to go out there and try to manage the 10-year at these levels, right? At some point it becomes disruptive, but I think for those that are thinking that you should buy duration because the Fed has your back, I don't think you have your back for at least another 50 to 100 basis points.
Sure. Yeah. And with that rise in rates, we've had some dollar strength, a little reversal of the weakness last year. And of course, on the far right, you see that commodities continue their march higher. Energy being kind of the big reversal, and we'll look at some equity performance with energy in the S&P doing really well there too.
Again, the reflation trade, it's the value sector things are beating.
Keeping on that reflation theme, we'll talk about the bond market. And the big question for the bond market is inflation. Is it coming? Is it here? Is it here for a little bit and going to go away? And more people are getting interested in this topic. And you can see here, this is a Google Trends. We like looking at this. We find this interesting. And man, there's a boom in the average American or average person out there Googling inflation.
Yeah. Well, if I look at that chart, what I see there too is that tends to be after the cycle kind of turns a little bit. So it's a bit earlier this time that you see the inflation. And why do you think that is, Ken? Why do you think everybody's worried about inflation today?
They want to buy stuff, and they think if the price is going higher, they should go buy it sooner than later.
Right. That's the problem with inflation, is that it's all about expectations, right? So if you think about expectations, if I expect the price to go higher, I want to go out and buy it. So it almost can become a self-fulfilling prophecy of creating inflation too. So it's something that a lot of investors haven't seen in their careers. We used to joke that there's a lot of people running hedge funds that never seen a rate hike, right? Yeah. There's a lot of people in their careers that haven't seen inflation above 2.5%, 3%. So it is a different regime, and a lot of people are going to change a lot of their thinking about it if indeed it does come to fruition.
Yeah, I mean, the only way you could have experienced this is if you go to another country. Argentina is a country that's seen inflation many, many times, and I remember going down there and being perplexed because there was everywhere I looked, there were brand new cars. You couldn't find an old car. It wouldn't be the nicest neighborhood, but all these brand new cars, and it kind of made sense. If your money is depreciating every day, right, you're like, I just got to go buy something with it.
That's right. And at least get some utility out of it, right? And at least you get that joy of the purchase, right? The dopamine kicks in, but also you feel good about the new car for at least a little bit, right? I did go to Argentina a couple years ago for one of my birthdays, and I think the year-over-year currency depreciation was like 60%. And so that wasn't the intention of going there. It's a beautiful country too.
Yeah, I remember talking to you about, should you exchange money at the ATM, or if you get the real exchange rate, you have to do it on the streets. And
right. What I was amazed at too is, when you travel, the rule they always use is you take your local currency out at the ATM, right? That's the way you do it. Don't use the exchangers and all of that. I was amazed though, you could never get more than $50, the equivalent of $50 out of the ATM at the time. And you couldn't do back-to-back transactions. So the good news is $50 went a long way.
Yeah, that's right. A lot of good steak, a lot of good wine.
Yeah, great place.
Here's another view at expectations and discussions of inflation. I was talking to investors towards the end of last year, and people ask, what are people not thinking about that they should think about? And I would say, I think they should think about inflation. And it's pretty remarkable. Towards the end of last year, 60% of investors were worried about inflation, and it seemed like right after the election is really when that turned, is the expectations of the kind of the blue wave and more fiscal, maybe like an infrastructure plan?
Yeah, you look at it, but I also would argue that the other thing that was there was the vaccination, right? It hit the week
same
after,
time,
right?
right?
Yeah,
Same
so
time.
you had the confluence of the two things, and then obviously the blue wave with the Georgia election. I think if you look at your chart, you see that, right? That's where the blue wave really kicked in.
Yeah.
Even though it wasn't the tsunami, it wasn't the wave, it was it was kind of a push, really.
Yeah.
But you've already seen it too, of them using that policy to get through the reconciliation process.
That's right. So let's take a look at fixed income. Last year, again, rates falling. Almost everything did really well unless you were not long duration, like a floating rate bank loan, or the parts of the market that were really hit by the lockdowns, like the commercial real estate market.
Right.
So CMBS was a big laggard.
Yeah.
And then this year, the reversal of that, clearly with rates selling off, all the high long duration stuff like investment grade corporate bonds.
Yeah.
In fact,
Worst start to the year ever, right? When I look at both the Barclays Ag, US Ag, look at the global Ag, or if we look at the investment grade corporate bond market. And a lot of investors sometimes scratch their head about this, like, wait, we have a good economy, I want to own corporate debt. But the thing we've been talking about for many, many years is just how the duration of the interest rate sensitivity has increased in that sector over the years. And it's playing out just in front of your eyes. Look at your chart, right? You can see it there. And so if there is more rate rise to come, there's more inflation, the pain will be felt in these markets. You know? So it's something that we were talking to clients about. Look, we didn't have enough duration in the portfolios last year, but we didn't capitulate. Rates have been on a rise really since the end of July, and it's been a measured pace. It did accelerate during, let's call it the late January, early February. But the idea there is that, first of all, it was inflation, right? It was the inflation expectation, just what you showed in the previous chart. But then also in the last few weeks, we've actually started to see via the TIPS market real growth being priced in as well. So if we start to actually get the expectations of real growth in the economy as well, you could really see rates continue to press higher. So we've added a little bit of duration to portfolios because, again, getting a little bit, you're still being underweight. Getting just a little bit more back in the portfolio as a natural, because now you have at least an offset, right? If something bad happens and we get derailed here, at least it can help you. When you have the long bond at 1%, which it hit last year,
or even with the 10-year at 50 basis points, like it was hopeless.
It's hopeless. Like, what are you playing for, right? That's what we always say. Like, what are you playing for? You had a duration 9. If the 10-year goes to 0, you make 4.5%. Whoop-de-doo. Right, that's not going to really do anything. So, but now it's starting to make a little more sense. We nibble a little bit higher. That's what we've been talking about at asset allocation meetings. But right now, let's watch it play out. And I know we'll talk about the directions there.
So what you're seeing is the stuff that lagged last year in the credit markets. A lot of the securitized assets doing really well this year as they play catch up. And the bond market. This is U.S. break even. So the bond market is saying they think that inflation is coming. And it's interesting because you're seeing a divergence between the 5-year break-evens and then the longer break-evens.
Yeah, but take a look at your chart too, right? So if you look at it, that pink line, that is the 5-year break-even, typically trades below or at the 10 and 30 years. So when people think inflation's coming, they're thinking it's going to permeate, it's going to exist for a while. And again, it looks like there's a big move here. And it was a big move if you own the positions. However, you're talking about really a range of like 50 basis points or so outside those two extrema, right? But now if you look at the chart today, what you see there is that the 5-year is significantly higher. The expectations of inflation are much higher. But if you look at the 10s and 30s, what that says is that people are thinking it's going to be somewhat of a supply shock, but it's going to fade
transitory.
away. Transitory. But transitory for 5 years isn't very transitory, I'd argue. If something's happening for 5 years, that's a pretty decent trend there. Yeah. But this is what I'm talking about why the curve reset was that you started to see this inflation expectations come in. And if you look at it too, the 5 years come down a little bit, but 10s and 30s are still on their march upwards. So I think this is definitely showing where investors are concerned about the inflationary side of the equation, and I think rightfully so.
And that's why bonds are making the moves they are. So we wanted to break out CPI and PCE and take a look at kind of what's actually those inputs that drive those numbers, right? And there's some interesting things that we've talked about in the past.
Yeah, and so when I look at CPI, what most people don't realize is the key difference between CPI and PCE. There's two major categories that have big weight differences. It's shelter and it's the medical services. And so, if I told you that CPI has historically been above PCE, which one would you think would have the higher weight to housing and which one would have the higher weight to medical? Well, the one that has the higher rate you think would have medical expenses, right? Because if you think about it, medical costs tend to always go up, but there's nuances. These are government calculated statistics. So what happens in the shelter component, it actually doesn't use house prices. CPI would be significantly higher if you use the FHFA data, which I know your team looks at a lot, or if you use like Case-Shiller, which a lot of people reference. CPI would probably be 125 to 150 basis points higher if you actually use house prices, but they use rent and what they call owner's equivalent rent. And those two things are important because if you think about what's happened during the COVID era, we've had a decrease in rents. So the supply price or the pressure on prices of the housing market isn't what you see in the strength of house prices. It's in rent and then backing into what they call owner's equivalent rent, or how much can you rent your house for. So that's put some pressure on it. The other thing about PCE, when you look at it, it's highly tilted towards this medical services area. And so if you go to the next chart and look at that, you'll see it. I did look at your charts this morning, so I know the order. But if you look at there on the medical side, it's almost, it's 21%. Well, how can this be giving us a significantly lower number if it has a bigger weighting to medical? Well, the good news is the government, just like your local representatives, they use Medicare reimbursement rates, right? So they have the single payer system, which is not what you and I pay, right? Not with our PPOs and the like. So it's a way to measure it. It is what it is. But what I find really intriguing here is that all this worry about inflation, and you're not seeing it in these numbers. Now, why do we care? Well, because most of the stuff like the tips market, everything we're talking about focuses on CPI. However, the Fed uses PCE, the personal consumption expenditure. And so there's a big difference there.
Yep. And so here we have PCE, and you've mentioned it a couple of times. Interesting about the inflation targeting and using PCE. It didn't really start till last decade.
Right. So you look here and you say, okay, the Fed uses this measure. And I think this is very important because you look here and you go, well, no wonder they use this. There's nothing wrong with this. Having an inflation rate north of 2, it's happened in history. It seems to be kind of average. You have that 2.2 number dotted line there because that came out in the FOMC meeting last week. That's the kind of average expectation of inflation for the Fed for 2021. But if you notice this chart, and we talked about the 2% inflation target. Now we know it's not 2%. They want to average 2% over a long period of time. Well, if we start to look at that, you got to put above 2 for a long time to get that average over the last decade north of 2. But what's also interesting is that the Fed's mandate on this 2% inflation target rate hasn't been around since the inception of the Fed. It actually was a policy change back in late 2011. So now let's look at your chart. Well, since the Fed introduced the 2% target rate, there's only been 2 regimes where they actually achieved at least the 2%. Was right when they started it. Kind of convenient, right?
Yeah.
You set a policy based on your data. But what you've seen is that the only other time since then that they've achieved that goal or that mandate was in the summer of 2018. And it was very short-lived. It was like 3 months.
Yeah, that's when we had that global growth boom where everything was firing on all cylinders.
It was the everything rally, right? Yeah. Kind of like last year, the everything rally. So when you look here, it's like, okay, fool me once, fool me twice, fool me thrice, keep fooling me. Not going to get fooled again. I guess that's what President Bush said, right? But if you think about it, we'll have to see how this really transpires. So I know there's base effects, like that's because we're talking about it in markets, right? The year-over-year comparisons. We're going to have the next couple of data prints are going to be off of very depressed levels because these are reported with a lag, a couple months lag. So we expect to see these numbers do hit those 2% targets this year. But the big question is, will it go through there? And then what happens with the Fed? Do they get cold feet? Do they start to get nervous? Do they think this self-fulfilling prophecy starts to take hold? So I think all eyes will be here for the next couple of months. We just got the most recent prints, the 152. It's nothing, no big deal. We all know the base effects. So the Fed's going to wave their hands and say, well, it's transitory, it's base effects. We all know that. But the question becomes, what happens to the consumer? Does it breach into their psyche that, oh gosh, here comes inflation, and creates that kind of, I won't call it the Argentinian experience, but it creates a different dynamic.
Yeah, I mean, that's the big debate even internally as we have our investment meetings is, is this a short-term thing? Is this supply shock based effects? Or is it in the long run, are we still in this kind of secular stagnation, deflationary phase where rates could, fall in the long run? And I guess the big change up really has been fiscal. Fiscal is the one thing that can change that.
Yeah, usually it takes a recession to get fiscal going. There's no fiscal hawks left. The MMT folks are winning right now, and you've got to respect it. Yeah, you can have your opinion about what you think about it, but it's coming. The infrastructure bill's coming. It may take till the fourth quarter where you can do reconciliation again to do that, where they don't have to get the 60 votes in the Senate. But it's you're going to see these things. So regardless of how you feel about the policy, you've got to have your portfolio positioned to make sure you can take advantage of this. And so when you think about it, what do you do here? Well, you should be cautious on rates, but also you should add in some stuff probably that goes down in price if inflation keeps coming, because what happens if it misses, right? Yeah. And so it's keeping that balance. It doesn't need to be barbelled. It should be tilted, but you probably should own some of those what if scenarios the other direction as well, because people are buying in these trades.
Yep. So let's look at some of the things that can cause inflation. Here's, of course, all the liquidity in the system. Money supply is skyrocketing. The thing that's been lagging is there's really been money velocity, but you're finally starting to perhaps see that tick up a little bit.
Yeah,
right?
We saw that bottom. I mean, this chart is scary to the inflationistas. This is what any inflationist will troll out, was this chart. I mean, and this only goes back for the last 2 decades, but you can go back through the history. Since the only peak we've seen in money supply like this was something equivalent to World War II with the war spending at that point in time. So this is the thing. Like, what happened? We create all this money. Why isn't it inflationary? And you're right, you nailed it on the velocity side of the equation. So let's talk about the reopening of the economy. If people have this money saved up, or there's stuff in the system that you're going to go consume and turn that over, that could create the side. So absent velocity, just money supply itself doesn't create inflation. You need both.
Yeah. So one of the things that has been around since the pandemic started is supply chain disruption. Mm-hmm. I live near the San Pedro and Long Beach Harbor, and if I ever come up the freeway that way, there's these big shipping containers like you see on the screen lined up, and was it 2 days ago, this huge one got stuck and it's blocking the Suez Canal.
Yeah, they got their best guys on it. They said they got their best guys
like
on it. I don't know what you do.
Ridiculous. I don't see how you move this thing, but
we've always talked about it's like turning the aircraft in the ocean, in the Panama Canal, or the aircraft carrier, right, or something like that. But the graphic is just amazing, right?
And but that you're seeing those price pressures. So this is prices paid, ISM prices paid, and it's up. I mean, prices of certain stuff is up, not everything, but there's been an interesting kind of recession, because usually services hang in there and then goods purchases drop. Right. But services, clearly, because we're not going to restaurants and hotels and things like that, have dropped. But people have been buying stuff for their home. Right. And I guess the bull case for growth is that people are going to keep buying stuff because they've saved money up and there's more pent-up demand. And then the bears say, well, you only need one new washing machine, you only need one new car. So there's been this like front loading of purchases, and that's going to slow down. Do you have any thoughts on that?
Yeah, I mean, I'm sympathetic to that thought that it could slow down, but the issue is we continue to see the data be strong, right? Yeah. And so this is the first time, really, I think it's about 7 or 8 years where we've actually seen goods inflation above service inflation. So I think the question really becomes, with the reopening and we start to consume on the service side again, is it a handoff between the two? Or are the stimmies coming, right? Like, so people have more money too. And so the government has definitely been mailing out checks, right? We have, an unprecedented amount of unemployment benefits that we've given out. And so I'm on the fence on this one too, but I think you just got to continue to watch the data. But I expect to see services take back up. I mean, since California's opened back up, you see the activity. I see pictures of, the restaurants. I mean, they're at full capacity. Well, they're limited capacity, but they're full. There's lines everywhere. I mean, so there is that pent up. And by the way, we got spring break right now, right? So I think you're going to see a kick in the service side, definitely. I'm just not sure how it translates to the goods, but given the amount of extra money that's been sloshing around, I'm not convinced that falls away either. And I think a lot of it is just, it's home improvement at the end of the day. We've seen it in housing. You've seen the Home Depots, the Lowe's of the world, and people are just saying, look, if I'm going to be stuck in this house every day, I'm going to make it look nicer. It's like we did in our offices here, right? Everybody's office, you spend money, you want to make your office nice because you spend so much time here. Yeah. But when you're not visiting it, you start to spend it elsewhere.
That's right. Yeah. And so as a function of everything we've talked about, inflation expectations, the reopening, the growth, rates have made a move. Here's a chart of the 10-year Treasury yield. It goes back about a little over a decade. And, through that time, we kind of traded in this range of we had the two lows in 2012 and 2016 where we had the intraday low of like 136-ish.
Yeah.
And then on the upper end, we, after the big rally, after the European crisis, we hit 3%-ish in taper tantrum, 2013. And then we tested that back in 18 when you saw that, again, that big global growth, until Jay Powell came in and decided he wanted to calm things down and he started hiking rates.
Yeah.
And it just, to me, it just seems like we're going back to that, old regime. And it doesn't seem that crazy to me. A lot of people are so spooked about rates going higher. Why did they need to be so low?
Right.
They went low because of the pandemic. Goldman put out a piece about a year ago, a little over a year ago. I remember because I was talking about it when we were on our roadshow. We were out selling a product, and they talked about how when you see, it wasn't for pandemics then. It was for SARS and MERS and things like that. That rates would fall and then they would normalize after some period of time. It just happens that this took longer.
Yeah, it's funny it took longer because everything seemed to happen so quickly, right? The declines, the rallies, and other things. And this is one thing that I've been pointing out in the investment for many, many months now is that you've seen the reflation idea. It started in stocks, right? And when we got depressed, we saw it spill over to commodities I talked about. Credit spreads started to normalize a bit as well. They really caught momentum latter half of the year, right? As the commodity pickup happened. But rates were the holdout. Look at your chart right here. Rates were really holding out. It took the vaccine idea to really kick it into motion. But it's just like the inflation concept. Once it gets into motion, it starts to really get back there. So one of our PMs, and I've quoted this on the podcast this week too, but he said, I'm mystified on why everybody's so mystified about rates. We should expect this. And I said, exactly. Yeah. That's exactly what we should expect. The rest of the markets are reflating, and so should rates. And so, look, is it too far, too fast? I don't think so. We're taking a breather here. We've had a rally for a little bit this week. But at the end of it, I think we continue to march higher because we have inflation expectations higher. We have a growth environment. It doesn't mean we're going to trade at nominal GDP like we used to, where that number could be 7 or 8%, because it's got to be nominal GDP over the 10-year period, right? So I think, the things we look at, and I'm sure you'll have charts on those too, they say rates should be higher. And so there's nothing wrong with higher rates.
It's a good thing.
It's a good thing, right? Because the nice thing about us as investors is that we're redeploying capital at higher yields. This is the beauty of bond funds versus owning single bonds, right? We have pay downs, we have, coupons come through. We're reinvesting at higher things. So if you can structure portfolios correctly, you can position them on the right part of the curve. And this is an environment to make money in fixed income.
Yeah, I mean, we talk about this a lot on the, I guess it used to be the trading desk. Now it's like the virtual trading desk. Rates higher is the best thing for investors. It's painful while it's happening, but once you go to higher yields, now you can actually earn some returns.
That's right.
And there's some arguments to be made that with this move in rates, unless there's some earnings in stocks, there's going to be competition for equities in bonds. Maybe not right here at 160 where we are today, but as we move higher into the twos, that kind of stock to bond ratio of earnings yield versus the 10-year Treasury yield.
Agree. And then look, you can look at some of the credit products and things like that. I mean, there's still places to make money in bonds. It's just that you're not going to do it in the highest quality. That's what Jay Powell wants. That's what QE is all about, is to push you out the risk spectrum. And so, but the problem with the Treasury market is the basis for everything. So if rates are pushing up there, then that means we're going to have some changes in yields across all the spectrum.
So we get a lot of questions from investors, how much higher will rates go? How much higher can rates go? So we have some charts to talk about that. So this is the 2s, 10s curve. So the difference between the 2-year and the 10-year. And, if there's inflation expectations, then typically the curve is going to be steeper. The curve inverts before you go into a recession, typically is the...
And it did it this time too?
It seems to work every time. So one thing, so this chart, when you look at it, makes you think, okay, we probably have another, at least 75 basis points to go higher, because we've moved about 150 and we've seen on average it moves about 250. Now, one big thing that's different is that usually when this is happening, there's also the front end of the curve falling a lot too.
Right.
So that
the Fed cutting rates, right?
The Fed cutting rates, and the Fed was already at a lower bound prior to this happening. So maybe with the front end not going down as much, we're not going to see as much of a move.
Right. So you look at your chart and you could argue, well, the front end did go down. It just went down in March, right? I mean, the Fed cut quick, they went big, they went early, and you can see that from that blue line there, right? So they dropped the rate very quickly, and the curve didn't.
But they started at 2 as opposed to in 05, 06, they were starting at like,
at 5 or 6, right? Yeah, exactly. And so I completely agree with your point. And so I keep reminding everybody that usually the steepening is about 250 basis points. And so let's talk about the front of the curve. So if the front of the curve's been pinned down and it doesn't have room to cut, maybe you haircut that 75. Maybe you haircut at 50. So if you look at the chart, that says we probably got another 25 to 50 to go in the cycle. That doesn't mean it stops there. It could continue to press on, especially with inflation, because in these regimes, you didn't see a lot of inflation coming in, at least a change in inflation. Yes, we had 4 and 5% inflation in the early 2000s, but that it's the change in inflation that matters. Just like yields. Yields, if we have a 3% 10-year and we have it for a year, the market, that's just the price. Remember, the housing market took that in 08. When we had a 3% 10-years because we already got to that. There's something about the psychosis where you see the number and that's just what you assume it is. So it's that change that comes in. But once you get to these levels, the levels are the levels. It's all about the change from there. So, I think we probably go 175 to 200 is probably where this does, except if inflation expectations change. Obviously, we'll have to see how the Fed responds too, because the 2-year is predicated on the Fed telling you they're not hiking for 2 years.
Yeah.
So if I got 0 for 2 years, I know how to price a 2-year bond.
And that, to me, it's just that's getting us back to normal. As I mentioned earlier when we looked at that chart of the 10-year Treasury yield, the average 10-year Treasury yield going back to like 2010 was around 220. Yeah. And it's not that far away.
Right. Now we're close. And that's the thing. So I don't see us having a 3 handle. I've said that we'll probably hit a 2 handle this year. People thought it was crazy saying that, in early January, but the charts just support it. The charts support the underlying data, the inflation, the growth all support that, but it doesn't support a 4% or 5% 10-year. That's going to take a big regime shift in inflation or a long-term change in the trajectory and the capacity of the economy. So remember, you talk about the 210 10-year. Remember my heuristic I just used? I said, okay, it trades kind of nominal GDP. Well, really, in this last cycle, it's traded real GDP. And if you look since the financial crisis, the growth rate of GDP right before COVID was about 2.2 or 2.3%.
Which is that out 2.2%?
It's perfect, right? And
yeah.
so that's exactly right. So when you think about this, what's the growth rate? Yes, we're going to have a big growth rate this year. Is it going to normalize next year? Are we going to get velocity? In order for us to get the real GDP potential up, meaning that you have a higher growth rate over the long term, is we've got to get velocity, we've got to get productive products. And that's CapEx. That's why infrastructure is on everybody's tongues again. It's been for 5 years, it feels like. But I do think that projects like that can really help the economy. And that's what you need if you're going to see a move up in rates.
So now here's a chart we talk about a lot, copper gold. This is just another reinforcer of we probably have a little bit more higher to go.
Yeah, it's a big gap, right? That's one of the biggest gaps we've seen on this kind of overlay chart. And sometimes you can lie with these overlay charts. I'm critical of them as a statistician, but this one's been a very good relationship and it's been leading. And so what I see here is that the directionality, right? It's not that they have to be on top of each other, but you notice here what's very good about this chart. When copper gold is declining, yields are starting to decline. They don't have to be in lockstep. It's directionality. And that's exactly what you see in this chart. And it augurs for significantly higher rates. But again, I think a little bit of it's distorted. You've had the strength in copper. You're likely to see more strength in copper because of supply constraints. So maybe that's giving a little bit distortion here. But I definitely see that this is a reason for saying, look, 225 on a 10-year makes sense.
Yep. All right. And now we've got the U.S. 10-year yield hedged for Japanese and European investors. And this is kind of the, will the foreign buying come back? Because the foreign buying had taken a step back as we raised rates through 18 and early 19, didn't make sense to buy because on a hedge basis you were less yield.
Less yield than local. I mean, like if you think about a European investor and using the bellwether like the German Bund, right, is thinking the high quality asset
Negative
there.
60 basis points or so, right?
Yeah, I mean it's really rallied this week, right, down to that. So there's a big gap here. Now at 100, do you care at 10 basis point difference? No. Do you care at 50? Maybe. At 100, 125, you start to care a little bit. And so I think that this you
especially
can see
for a high quality asset, right?
That's
because
right.
now you're getting the investment grade corporate type spread on a government related bond, right?
That's right. And so as long as you're doing your hedging, right, which is important, and so many investors got burned with not hedging the currency, and so this is really what bond investors look at here. But because of those interest rate differentials closing, it's helped the currency and the hedging costs go down a fair amount. You can see, look at the hedging costs at one point. The difference between that blue line and purple or orange back in 18. you were talking almost 300 basis points of what it costs to hedge
Yeah.
on an annualized basis. Now you're talking about something, depending on the currency, 30 to 50 basis points difference, right? So it's definitely seems more attractive. We haven't seen foreign buying really step in significantly. And so maybe they're going to wait. Maybe they want a higher number. They don't want to start averaging in yet. But if I look at the tick data, there's really not an uptick in foreign flows into U.S. Treasuries at this point.
All right, now we're going to look at some we've talked about bonds a lot, but we'll talk about some drawdowns. This is the third worst start to a year since 1830 per Deutsche Bank.
Yeah, I mean, and when you look at that, it's like, okay, well, in the context, not as bad as the inflation era of the 70s, right? But remember, this is like the first couple months, right? Where the rest of them, I believe, are looking at years. So, or I guess it is January and February. It's gotten worse in March. I think you have the other chart, right? If you move on.
Yeah, so this is the 10-year Treasury yield. This goes back to 1987.
Right. So 10% drawdown. Who would think owning, buying a Treasury, you're going to be down 10%, right? But this is the problem with having low yields and lots of duration.
Yeah, when your coupon, or probably some of the lowest coupon treasuries that have ever been issued, right? Mm-hmm. So you have no kind of coupon to help the blow of the drawdown, right?
What I'd like to tell investors, especially when you're in a good yielding environment, is that yield helps you make helps you offset a lot of price mistakes, right? You don't have to care as much about the nuance, but if you're buying something at 50 basis points, you better be dang sure of the direction of interest rates at that point in time, because as you see, you own it from the peak, and I think this is from July of last year. I guess you could argue maybe March was the low, but I think with the coupon helped you until July, so I think the peak was really at the end of July. But being down 10% there, I mean, you got to scratch your head like, what were people thinking buying a 50 basis point 10-year? This is what happens, right?
Yeah.
And you can see it's not out of context.
They thought it was going to negative 50, right?
And I've heard that argument, and
it could get there,
but it could still happen. But at this point, it just shows you some of the pain out there. But this is also why, at this stage now, maybe it makes sense to add a little bit of duration back to portfolios, because now at least if this rallies, you can make some money off of it, right? So I'm not saying we're going back to 50, but it does make sense to start legging into the trade.
Yeah, I mean, at 50 basis points, it just looked like your upside. Let's say we went to zero, was 50 basis points of decline, and infinite upside. I mean, not truly infinite, but you know what I mean. But now that we've seen these retracements back to these higher yields, it is starting to kind of look a little bit more interesting. 30-year, same kind of thing. We haven't seen anything like this since 0809. So,
and that was the reflect. It's the same environment here too. So these charts, to me, they augur for why investors maybe should be adding a little bit of duration back, right? This has been a ruthless sell-off. I mean, you can see from this chart here that the sell-off has been, some of the most painful you've seen, and it was sharp, very quick, right? So the idea, if we talk about that normalization, look at average rates and things like that of this newer regime where we really never got out of QE. Right? That's one thing we've been talking about here for many years, is that really we've been doing QE since the financial crisis. We never really had a true recovery. It was all done by the government. And so I think when you look at how that setup played out, we were going to go back to that type of environment. We had the government bailing us all out. Now we have fiscal side, right? We're stuffing money into people's pockets. So I think it makes sense that we go back to kind of this post-financial crisis growth rate. It's going to be a short-term blip this year. We'll see if it has legs, but I would bet that we're going closer to that average post-financial crisis in terms of GDP growth, in terms of economic activity, and profit margins on the equity side.
Yep. Okay. Last but not least, for on the government guaranteed side, one of the things that you've recently seen, this shows the correlation between stocks and bonds, usually negative, which is why you like to own bonds, because if your stocks go down, hopefully your bonds go up. But sometimes your stocks and your bonds go down together.
Right.
Sometimes they go up together, and recently you've seen that happen. And it's something that you've mentioned. It usually happens, that flip-flop happens when vol picks up, right?
When vol, yeah. And if you notice too, you said, well, usually it's negatively correlated, but that's in the last decade it's been negatively correlated. So go back and look at your bottom chart there. You could argue, okay, the last 2 decades, right, too, they've been negatively correlated. But in the 90s, they were positively correlated. In an inflationary environment, they're positively correlated, like in the 70s. And so, you got to be careful of extrapolating these relationships and really understand what the drivers of those are too. So if you're betting on stock and bond, just having this negative correlation, and it doesn't happen, you're down on both sides of the portfolio. You're not insulated. You're not kind of risk balanced. And so this is something that we were talking to clients about in the late third quarter, when, especially the RIA community, right? They're talking about the 60-40 in this and the merits of it. I said, I don't believe in the merits of 60-40 right now. I just don't think that because of the 10-year being so low at 50 basis points, it doesn't help you if we get a sell-off in stocks, unless we go extremely negative. You have to bet on that relationship, and are you willing to do so? But now that we got these rates a little bit higher, there's some cushion in there, a little bit more yield in there, it probably makes a little bit more sense. But again, this is called being a market timer or trying to tilt portfolios versus just having that static allocation.
Yeah, I mean, at one point in time, if someone said, "Hey, should I own the 10-year Treasury or should I just own cash?" I'm like, well, cash doesn't go down in price.
It's a zero yield versus 50 basis points.
Yeah.
You know, I mean, like, yeah, and that's what they're coming into this. Oh, the reflation trade. What do you like? I like short duration bonds. That's what we were talking about in the fourth quarter and talking about our clients. It's like, look, you at this stage you can outstrip inflation. You don't have to take the duration risk. The curve was still somewhat flattish between, let's call it the 1 year and the 6-7 year part of the curve where an intermediate bond fund is. Why not? Why not just do that? Now you have a little more juice in the market, right? Because the steepness of the curve is helping. So there's ways that the intermediate term type of strategy now can help you, right? And it can work. But again, you have to have that balance also in there between some rate risk, some credit risk, some floating rate. Floating rate's been very good this year, as you identified in those charts. And so that's part of active management. That's what we do, so investors don't have to worry about it.